My mission is simple: to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. From the stock market's perspective, this election's become mega versus MAGA. Wall Street's trying to make up its mind about what it means for Biden to drop out, with Kamala Harris almost certainly becoming the Democratic nominee. I think the race will shake out as one candidate who's happy to work with mega cap tech, and then the candidate of MAGA, which doesn't necessarily translate into support for mega cap tech. You can see this view on display all day today, with Dow advanced 128 points, S&P 500 gained 1.08%, but the NASDAQ, the tech-heavy NASDAQ, that went up 1.58%. Pretty much exactly as it should be in a mega versus MAGA stock world. A lot of people seem very confused by the juxtaposition of Kamala Harris and Joe Biden, just as they seem confused by the implications of Donald Trump picking J.D. Vance as his running mate. I am not confused, at least not when it comes to the stock market. Trump adding Vance to the ticket means the Republican Party is going full-on nativist. They're embracing the politics of the late 1800s populist party, although that was considered an extremely left-wing movement at the time, one that was aimed at curtailing the power of the robber barons and the money men on Wall Street. Still, with the Trump-Vance ticket, there can be no doubt the old free market Republicans have been obliterated. In their place is an American-first withdrawal from the rest of the world, where all the money in the industry is left here. Tariffs go up, and the government makes it much harder for businesses to move their operations overseas. The days when other countries threw up tariffs and all sorts of other trade barriers to American goods, then we open our factories there, government does nothing to retaliate, they're gone. They're done with Trump. In their place, if Trump is elected, in some cases, will be a pay-to-play military plan, which you could uncharitably call protection money. Novel approach, serious and real bad for business. But it's meant to make America great again, not make business great again. I think that's why the small cap rally has such staying power, just like much of the Russell 2000 roared back in 2016 when Trump was elected president. In fact, that was the last time the index had such a historical prolonged run. The small cap rally is more pronounced this time, possibly because Vance injects a level of certainty into the scheme, and Trump remains heavily favored to win the White House. There's no more lip service. International companies better get their act together with his game plan or get out. The chip NVIDIA is allowed to make, for instance, for China, might be conceivably made illegal under a MAGA regime. But how about the other side of the trade? That's more interesting to me because it just unfolded yesterday, the Kamala Harris side. Here's where I disagree with pretty much everything you've heard about in the last 24 hours. I think Harris would be way better for big business than Biden, and certainly better for big business than Trump. Sure, she wants higher tax rates for corporations. That could be an issue. That was the smokescreen I heard all day today. However, I'm talking about something very different here. I'm talking about an ethos so deep that it's actually somewhat historic. At their best, the Trump-Vance ticket stands for helping small businesses thrive, making them keystones of towns all over America before those towns were crushed by deindustrialization. They see that as a huge problem. They want to bring that world back, along with better wages for our workers. Harris, on the other hand, is a true believer in globalization, much like most of our leaders prior to 2016. In Trump's world, Taiwan stole our semiconductor manufacturing jobs, so now it should pay a price for the protection of the U.S. military. But I suspect Harris will share the vision of Gina Raimondo, the current Commerce Secretary, who recognizes Taiwan is a friend, one that needs to be defended, even as we subsidize our own domestic semiconductor manufacturing in order to get more control over the supply chain. What makes Harris different from Biden? Look, President Biden is someone who, by his own admission, doesn't know all that much about capital. He's arguably the most pro-union president in history, something he's proclaimed endlessly. Walk the picket line against Ford. That's been Biden's approach to populism, an adversarial attitude to big business and small business, for that matter. But Harris, I don't think she has the same view. She didn't before she hooked up with Biden and became just vice president. So she's an elected official from California. She knows the people who run Silicon Valley. The people I know who talk to her regard Harris as very sophisticated about what these companies do. And she doesn't want to hector them, as Biden's done rather endlessly through the Federal Trade Commission and the Justice Department's antitrust division. Biden's agencies seem to believe big business is bad business. From what I'm hearing, Harris has what I call a more nuanced approach. Moreover, Harris has a secret weapon, her brother-in-law, Tony West. He's the current general counsel of Uber and the former general counsel of PepsiCo. Before that, he served as a key Justice Department official who did his best to fight for the American people against the banks that were partially responsible for the Great Recession. You better believe the general counsel of Uber knows something about the internet and something about the ingenuity of our great American tech businesses. Through the help of West, whom I hope would be a close advisor, there can be a conversation between the people who run these companies and the President of the United States. Right now, I think there's not much discussion. With Biden, instead, it's all done through the regulatory agencies, which, again, are antagonistic to power. The mega caps are often seen as too powerful, hence why Biden's FTC and Justice Department have it in for them. In a Harris regime, mega isn't per se bad. What a change of pace that would be. Now, you may ask, isn't being kind and civil and understanding of mega caps bad for our country? Look, I care greatly about our country, but do you come to me to learn my Hamiltonian view on big business? Do you want to know my feelings about Taiwan and whether they should be punished for taking our businesses? No, you don't. You want to know how to make money from events. And I'm saying to you that Harris would be more understanding president than Biden when it comes to business. She gets that not all businesses are bad. Some are good actors. Sometimes good businesses do things that aren't great, but they don't need to be prosecuted to get them to change, as I feel is currently the case. I don't want to generalize too much about what to expect from her because she just started running. But those who've seen Harris in action, those who've talked to her before she became a team player for the Biden administration, generally seem to respect her as a case-by-case adjudicator. You can see her having an honest, thorough discussion with Tim Cook, CEO of Apple, Andy Jassy, CEO of Amazon, Ruth Porat, president of Alphabet, Jensen Huang, CEO of NVIDIA. That's probably not going to ever happen under President Trump, and it definitely didn't happen under President Biden. The latter seem to be relatively unsure about what these companies even do. Bottom line, if you're looking to invest in tech, you want a world where tech has a voice in Washington, not slash vocal cords under Trump or on mute under Biden. If you own many stocks of international companies and you want to vote your portfolio, Harris is more likely to help than hurt. That's more than I can say about everyone else, and it is why you saw most of mega rally today. How about we go to Tony in Florida, please? Tony.
Hey, Jim, I just want to tell you hit it out of the park in the last monthly meeting. You hit a grand slam.
Oh, thank you. Actually, a lot of people like that call. Jeff Marks did a great job, too. We talked about some new stocks. How can I help you?
Yeah, this holding that I want to get into, I drink every morning now instead of coffee, and it has no sugar in it, so it's a lot better for diabetics like me. And it's trying to go against Monster and everything. It's Celsius Holding. Do you think that the buy that is so low as
I have to tell you, this stock does seem to go down every single day. It's almost as if people felt it had to stay in the sun. I don't necessarily want to write it off, but the numbers have not been good of late. So the stock is going to track that, Tony, until there's some turn. And I know it's down from 99 in a straight line from March, but I have to tell you, if the numbers were better, this wouldn't be happening. Dylan in Texas. Dylan.
Hey, Jim. Thanks for taking my call, buddy. I just wanted to see what your thoughts were on HubSpot, ticker symbol HUBS.
Okay, I think HubSpot is too high. I don't think that, first of all, I really don't like enterprise software, and I've been dead right. I've been dead right to hate enterprise software. Second, this stock is down on was takeover talk, and I don't think it's going to recover all that easily. It's too expensive, and I hope it makes a lot of money next year. But right now, it's just very, very expensive. I'm down on enterprise software. I'm down on HubSpot. I like two enterprise software companies. I like ServiceNow, and I like Salesforce. Let's go to Kevin in Indiana. Kevin.
Hey, Jim. Thanks for taking my call.
Of course. What's up?
Jim, I started investing in the late 90s. The dot-com bubble hit, and I bailed out. I panicked. Then I started listening to you. I got back in on the lows, and the rest is history, Jim.
Oh, fantastic, man. Thank you. You had some good calls. Thank you very much.
I manage over $1 million in the market now, and I'm retired, 67 years old, and it's a lot of fun.
Well played, my friend. Well played. Congratulations.
Thanks for your guidance.
I celebrate people like you. Thank you for calling in.
I'm just a regular Joe Schmo.
We all are, my friend. We all are. How can I help?
Okay. I've had this Whirlpool stock for quite a while, and when it went down to 88, I loaded up on it, and now it's going up. Is it when interest rates come down and housing comes back, is it going to go up more?
Yes, it will. My concern is that I want them to be able to pay that dividend. I do worry that it is not as well. This deal they did, this international deal, I did not like. I've made that very clear. It is a very inexpensive stock, and if you can take a little pain before the dip, it reminds me very much of Best Buy, which you know from the club has been a winner for us, but it sure looked like a loser. They're in the same boat, Best Buy and Whirlpool. So I say we take some pain, we get the gain. If you're looking to invest in tech, you want a world where tech has a voice in Washington. From what I can tell so far, Harris is more likely to help with that than hurt. On Mad Money tonight, American Express reported what I thought was an excellent quarter, but its stock fell in response. So has my thesis changed in the credit card company now that we know more about how it's doing? I'll give you my take. Then Intuitive Surgical is firing on all cylinders, but as the stock went up too much to get in the action, I'm sharing where, let's say, what could happen. And Wall Street was not happy with Domino's guidance last week. And with the stock giving up most of this year's gains, what should you make of the pizza chain that I have so long championed? I'm getting the latest from the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Between the global tech outage caused by a buggy CrowdStrike update and the insanity that is the 2024 election, you might have missed one of Friday's biggest earnings reports. It's from American Express. Regular viewers know I am a big fan of the credit card company for years, and I've stuck with it despite the newfound worries about the health of the consumer. I've been right, too. But on Friday, American Express reported what I thought was an excellent quarter when I got up in the morning, yet it stopped, finished the day down 2.7%. I think it's another example in a long line of American Express sell-offs that fake you out after what's been a tremendous long-time winner, one that rallied 80% from its lows last October to its highs last week. Yeah, every single time they report, there's big sellers. What the heck is that about? What makes me so confident here? First, even though the company's billed business and total revenues both came in a bit light, when you drill down and focus on profitability, American Express grew its net income by 39% year over year, including a gain from the sale of its fraud detection software business. Even excluding that, though, and that was a one-time gain, they adjusted earnings per share. Get this. They grew 21% to $3.49. Wall Street was only looking for $3.24. That's a big-time upside. At the same time, management raised the full-year earnings forecast by 65 cents. The new range is well ahead of what the analysts were looking for going into the quarter. That's despite leaving their full-year revenue forecast unchanged at 9 to 11% growth. So then why do we see such a sour response to the quarter? All right, let's start with the alleged negatives, all right? Even though I don't necessarily agree that they're all valid reasons to sell the stock, got to get them out there. First, given the stock's huge gains over these past several months, expectations were high heading into the quarter. American Express came in too hot. And look, you can see it. I mean, it has these moves. Almost every one of these is when they report the quarter, people sell the darn thing off. If you want some context, American Express was up 33% going into the beginning of the year. So you can go in, you can see this, and get this. That's more than double the S&P's gain at the same time. Vastly more impressive than MasterCard or Visa, up 5% and 3% respectively, even though those have no credit risk and American Express does. Second, American Express didn't get much credit for raising its earnings guidance because while the company raised its full-year outlook by 65 cents, management also said that its results for the second quarter got a 66-cent boost from their sale of a Certify. Now, that's a one-off, so Wall Street doesn't care. In fact, when you factor in the 25-cent earnings beat for the second quarter, you could argue that the new forecast represents a guide down for the second half of the year. That, and most important, third, American Express had a revenue shortfall, one that represents a slowdown from the previous quarter. Basically, while management's standing by their full-year revenue forecast from 9 to 11% growth, the revenue growth has already slowed from 11% in the first quarter to 8%. And I think this is the most legitimate concern, even as I'm more focused on the earnings lines, which were very strong. Yeah, we got to go over this because it's really important. The final concern is elevated marketing expenses, and this is the one that I took seriously. While American Express consolidated expenses were only up 1%, which is impressive when paired with their 5% billed business growth and 8% revenue growth, some investors and analysts keyed in on one line from the report when the company said that its 1% increase in expenses, quote, primarily reflected higher variable customer engagement costs driven by higher card member spending and usage of travel-related benefits and increased marketing investments end quote. Basically, the fear is that American Express is having to spend aggressively on ads and cardholder benefits to keep its member bill and billings growth elevated. Frankly, that may or may not be true. But if the company's putting up excellent earnings growth despite its elevated marketing costs, I come back and say, who cares? Now, you know why American Express sold off on Friday, but I need you to understand why that sell-off was both a mistake and a buying opportunity. First things first, let's not overlook the huge earnings beat. Whether or not you include the gain of the sale of Assertify or not, American Express has very simple long-term targets. They aim to grow revenues at a double-digit clip and earnings at a mid-teens clip. In this most recent quarter, they hit 21% earnings growth, which is worse than what I've gotten used to, but still well above the target. This is why I'm not sweating the small stuff, because American Express is killing it. While the stock's up significantly over the past 9 months, I still think it's not getting enough credit for its remarkable earnings growth. Second, Amex has real strength with millennials and Gen Z. Now, that's not new. It's been part of my bull case for the stock for ages, but it was once again on full display this quarter. Their U.S. consumer service business was up 6% overall, with spending from Amex's millennial and Gen Z customers up 13%, compared to 5% growth for Gen X customers and just 2% growth for the baby boomer cohort. As CFO Christopher Lekaliuk said on the conference call, quote, these younger card members continue to demonstrate strong engagement, and we see that they transact over 25% more on average than our older customers. And in some categories like dining, they transact almost twice as much, end quote. They're probably the key reason why Amex made the quarter. But for me, this matters for the future. I love how successful American Express has been with the younger generation because it gives me confidence that this strength can continue for many years to come. That elevated marketing budget everyone was so worried about, I mentioned I take it seriously. It is helping them own the younger demographic, which I think is very much worth it. Third positive, Amex's credit metrics. They dispelled a major bearish concern. Over the past couple of years, there have been occasional worries about the company's credit metrics. Yet they never get credit when these numbers are good. On Friday, American Express put up some solid, very solid credit metrics. Total provision for credit losses was up just 6% year over year, substantially lower than expected. Write-off rates and delinquencies, they look totally benign to me. In fact, American Express's delinquency rate dipped a bit quarter over quarter. Plus, it remains well below pre-pandemic levels. Very impressive. Finally, do not forget that American Express is now ramping its capital return efforts, returning $2.3 billion to shareholders last quarter, by far the most we've seen in the past 6 quarters. Even though Amex raised its dividend by 17% over this year, that's big. It still doesn't have all that huge a payout. Its yield clocks in at just over 1%. Much of that capital being returned instead comes in the form of buybacks. Over the past year, American Express has shrunk its share count by 3%. If you go back further, the numbers are even more impressive. The share count has come down from around 1.2 billion in early 2011 to just over 700 million now. That's an underappreciated aspect of the stock. I always like to check out the share count. Represents a permanent tailwind for the share price. So here's the bottom line. American Express turned in another very strong quarter on Friday morning, but for whatever reason, as seems to be the case every time the stock sold off in response, I think that's a mistake. You can argue it was due for a pullback given how much it run this year, but I see this as a very viable dip, which is why you've got my blessing to pounce tomorrow, if you want to, on American Express. Mad Money's back after the break.
Coming up, does Intuitive Surgical have room to run after a solid quarter? Go beyond the earnings beat with Cramer for a closer look. Next.
Over the past year, we finally started getting through our COVID-era medical backlog, with people catching up on non-urgent procedures that they postponed during the pandemic. Now, that's been horrible for health insurers that have to pay for it, but it's terrific for the medical device companies that are used. We saw a shining example of this late last week when longtime Cramer fave Intuitive Surgical reported a spectacular quarter. Remember, this is the company that makes machines for robot-assisted, minimally invasive surgery. Even though the stock had been selling off earlier this month as part of a broader rotation out of the market's hottest names, as the laggards finally played catch-up, that all changed when Intuitive Surgical reported. See, these guys delivered a strong sales and earnings beat with revenue up 14% year over year, while the earnings came in at $1.78 per share. Wall Street was only looking for $1.54. Do you know that translates to 25% earnings growth? Just important, both the revenue growth and the earnings growth accelerated from the previous quarter. Accelerated revenue growth, hard to find. Now, Intuitive Surgical has 2 main lines of business. You can think of them as the razors and the razor blades. First, they sell these big, expensive Da Vinci surgical systems. Then they sell consumable kits that you need for every procedure you run on these things. Last quarter, the company placed 341 Da Vinci surgical systems, up from 331 the year before. As for the consumable side, worldwide procedures growth came in at roughly 17%. Now, that is better than the 15.5% number that Wall Street was looking for. That represents an acceleration from 16% procedures growth in the previous quarter. That's actually unlike almost every other company in the space. Of course, you almost never see a stock surging 9% in a single day without a great forecast. And this time, Intuitive Surgical raised the low end of its full-year forecast growth from 14% to 15.5%. They also cut their operating expense outlook. Very, very good. On the conference call, we heard a lot of positivity. First, we got some context on this 17% procedure growth result. Most came from a larger install base, but there was also a 2% increase in average system utilization. That shows hospitals and surgical centers are getting more use out of the machines. It's the whole medical technology thesis that we like so much on the show. Meanwhile, procedures outside the U.S. were up 22%, reflecting strong growth in general surgery, gynecology, and thoracic surgery. But U.S. procedure growth still grew a solid 14% in the period, driven by growth in general surgery, which offset a mid-single-digit decline in bariatric surgery. Now, look, by the way, everyone's been worried that these GLP-1 weight loss drugs would crush bariatric surgery and thus crush Intuitive Surgical. But the declines really haven't been that bad, and certainly down one is not going to crush the story entirely. There's enough business in other types of surgery to absorb that impact, even though it is jarring to see any number down like that. We also heard about growth opportunities. First, there's the new Da Vinci 5 system, which accounted for roughly half the company's system placements in the U.S. last quarter. Management made it clear that the Da Vinci 5 launch would be measured throughout the back half of 2024 and early 2025. Intuitive Surgical is very careful about collecting feedback as it launches the new system, but the early customer feedback has been very good for this one. Management also called out the success of its digital platform, including an app, My Intuitive, that's now used by nearly 14,000 surgeons. That's a major reason why the number of surgeons using Intuitive has more than doubled versus a year ago. That's amazing. Management believes that increasing the reach of their digital ecosystem will be a big growth driver for their hardware over time. Also in the call, Intuitive called out the success of the international growth initiatives. They're seeing success in Europe, especially Germany, the UK, and Italy. They're seeing success in Asia, led by Japan and India, although China, like with so many other medical device companies, remains difficult. Frankly, China doesn't seem great for these guys right now. Honestly, it's pretty bad for everyone. Finally, there was some talk about all the potential new indications that could be on the horizon, with a focus on positive results from a major rectal cancer management clinical trial in China, studying robotic-assisted surgery versus laparoscopic surgery and open surgery as treatments. Overall, I think this was another great set of numbers from Intuitive. Their growth accelerated from the first to second quarter as the company rides the wave of elevated surgical procedures worldwide. My only real concern right now is the stock is about valuation, especially after its monster move in the wake of the quarter. The darn thing made a new all-time high today. At its current levels, Intuitive Surgical sells it for roughly 70 times this year's earnings estimate. 70 times. That certainly ain't cheap. But then again, Intuitive Surgical's always been expensive. In early 2021, the stock sold for as much as 85 times forward earnings. For the past 5 years, in fact, the stock's had an average valuation of 58 times forward earnings. So while 70 times these numbers is high, believe it or not, it's not insanely expensive versus its own history. Listen, I could tell you that Intuitive Surgical is cheaper if you look to the out years. It trades at 60 times next year's earnings estimates, 52 times 2026 earnings estimates. I can also tell you that Intuitive Surgical has beaten the estimates for 6 straight quarters, and the size of these beats is just growing over the past 4 quarters. So maybe the estimates are simply too low. Maybe the stock actually cheaper than it looks, as has often been the case. I believe, though, although it's hard to say how much cheaper than it looks, valuation has never really mattered all that much for companies with repeatedly explosive growth like ISRG, hence why we keep recommending it. In the end, the truth is that as much as I like Intuitive Surgical, it really does feel like you're chasing here with the stock up 10% over the past 2 days, trading now at an all-time high. So here's what I'll say instead. This company's firing on all cylinders. And if you don't own the stock already, it should be on your shopping list in preparation. Hey, look, we're going to have a market-wide pullback. You know we have these. Look to this one. We tend to get plenty of these kind of market-wide pullbacks in August and September. So in a particularly wild election year, I wouldn't be surprised if we get a 5 to 10% pullback at some point, and you got to pounce. Bottom line, when the pullback comes, that's when you can start picking up some Intuitive Surgical off these terrific numbers. Let the market throw it out on some big picture worries that have nothing to do with the underlying business, and then you can buy it hand over fist. Yes, it really is that good. Yes, it's really worth owning. Let's go to Trey in Texas. Trey.
Jim, I'm at the age where shaking hands with strangers is quite nerve-wracking. Do I lean forward and show them the double chin or lean back and reveal the receding hairline? Fortunately, there's a company dedicated to slimming me down and restoring my once Greek god-like hair. Should this work, is personal care product provider Hims & Hers a buy?
I have liked the stock. I did a piece about it when it dropped back down to the low 20s. It's kind of stuck here, but I think it's got look, the drugs that are like Wegovy and Mounjaro and Zepbound, and I think it's got what you just described, and I don't think it's that expensive given all the growth it has. The stock is up 128% for the year, which is why it's prone to some profit taking. But I agree with you, Trey, and I don't care, double chin, hirsute, whatever, you're in good shape. Gloria in Illinois. Gloria.
Hi, Jim.
Hi.
My husband and I watched your show for many years, but he's gone to heaven now. Our friend Don from Illinois calls you, and he says I need to be more diversified since I have mostly health and tech stocks. So what do you think about Procter & Gamble?
I think Procter's terrific. It's a big position for my charitable trust. A lot of times, Jeff Marks and I bat them back and forth, and I was thinking maybe at 169 we ought to sell it, but it sells at 25 times earnings, and I like it still. It's got a 2.5% yield, 2.3. I just think that Procter, you're not going to go wrong with it here. They're doing a lot of things great. Maybe get 3-4% growth. It's terrific. Let's go to Rod in New York. Rod.
Hey, Jim, it's Rod from Syracuse, man. Longtime club member.
Excellent.
Excellent. I'm up 70% this year in my portfolio, thanks to those.
Wow.
So, I want to thank you for your work. I want to thank you for your work ethic, sir. It's inspiring.
Thank you. Thank you.
I went out on my own outside the club stocks with one called Vertex Pharmaceuticals. I'm up 20% in the last 6 months. So my question is, should I trim it?
No. Vertex, I wanted to add it at one point to the fund. It is just so good. It has CF down. They're working very hard on this, the non-addictive painkillers. This is a winning stock. And the fact that I haven't added to the club, to my travel trust is my fault. It's a terrific situation, and I do not want you to sell it even at this all-time high. Man, our viewers are so smart. All right, listen, I think Intuitive Surgical has a lot going for it, and I give you my blessing to buy it hand over fist, but only if you wait for a solid pullback first, because it just spiked, and I don't like to recommend coming in after a spike. I have much more Mad Money ahead, including my exclusive with Domino's. After seeing on earnings, I'm seeing if the company can start delivering for shareholders when I check in with the CEO. Then Nike, Starbucks, and Estee Lauder are all struggling to find their footing. But I think one of these companies has a chance to turn itself around. I'll reveal the name of my thesis. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. What do we make of this harsh action in Domino's Pizza? It lost over 13% of its value last Thursday in response to its latest results. You know I'm a big believer in Domino's, but even though the company reported a solid earnings beat with inline sales, Wall Street was not happy with the guidance. See, management cut their international annual net store growth outlook while also suspending the global net stores forecast because of problems at their largest franchisee, Domino's Pizza Enterprises. So could this be your chance to buy a phenomenal long-term performer on weakness? Or maybe we need to be a little more worried. Let's check in with Russell Wieners, the new CEO of Domino's Pizza, to get a better sense of the numbers. Mr. Wiener, welcome back to Mad Money.
Jim, thanks so much for having me.
All right, I say new, but that's only because we haven't seen you that much. I'm so thrilled you're here because I think people want to know, is something awry? Because one thing I've said about Domino's, this is the most consistent story I follow, but I didn't know about the DPE, and I didn't suspect you to pull guidance.
Well, you're right on consistency. I started in marketing in 2010. We launched the new pizza, and you called us at $10. So thanks.
I got that right.
You did pretty well.
Well, that's because my kids love Domino's. And then you added the no cheese button, and they're vegetarians, so they're really fabulous. Vegans.
Well, we've been very consistent over the years. What I heard from investors when I talked to them after the call was the DPE thing was a surprise. Our job, Jim, as you know, is to provide only, positive surprises. We're supposed to be consistent. There was a miss there. We had to take guidance down, like you said, 175 to 275. I met Domino's Pizza Enterprises CEO Don May here in New York a couple of weeks ago. That's what our teams are focused on. So
that's more than 3,000 stores.
He's disappointed, yes.
But at the same time, that's not tens of millions of dollars that we're talking about.
No,
it's more than that.
But, Jim, we gave a number. Our job's to hit it. For perspective, though, on our international business, we've got 40 to 50% of our growth is coming from China and India. Right. China just increased their store growth targets from 300 to 350 a year. India and the 6 markets, Jubilant runs 5,500 stores a year. So when you're in 90 plus markets around the world, You're going to have some fits and starts in some, but the beauty is you have the other markets to round things out. Now, the other piece of information I got from investors was wow on this U.S. business.
Right.
Because, and you know this, you've been covering this, 4.8% positive same-store sales is a good number, but the quality of those sales are through people coming into our stores more. It's through traffic. Traffic in QSR now, folks are struggling because prices are a little bit high.
But you're saying it's not from price. You didn't raise price big and therefore hit the numbers. That's not what happened.
No. We like to think we have profit power. People talk pricing power. We price for profits for our franchisees, which means driving the top line. It also means really good value for customers. And I think that's why people are coming to Domino's now. Our value has never been better. So today's orders are tomorrow's sales. We increase orders on our delivery business, carryout business, every single income segment. I don't think anyone's doing that in our industry.
I want to put this DPE, this outfit, to rest, though. It's a publicly traded company. Why did you not get a heads up from them that there were problems? Why did we learn this on the day of earnings?
Yeah, well, they did announce the day before. The way our process works every year is we budget with our master franchisees. We actually had a pretty conservative number for them this year because last year was a little bit tough. We were working together in Q2, and it looked like Q2 wasn't going to hit. Teams got together and said, you know what, we got to say something as soon as we know, and that's what we did.
I got it. Okay, now let's talk about the things that I think are very exciting.
Yeah.
First, let's talk about you very rarely add something. When you do add something, it's a big deal. You added New York style. How's that going?
Yeah, it's great. Jim, I call it innovation with intent. Right. Sometimes you look and people launch products, you wonder, why did they do this? We launch about 2 products a year now with our new Hungry for More strategy. The question is why New York Pizza, not just we're launching.
or those each have that's an acronym.
Yeah, Hungry for More. More sales, more stores, more profit. How? 4 ways, right? Most delicious food. It's all about the products you launch and making them delicious. Operational excellence is the O. We're delivering 10% better than we were 2 years ago, right? Renowned value, that's why we're getting all these people in. Right. And everything we do is enhanced by our best-in-class franchisees. So the New York style pizza, we looked at our portfolio, and believe it or not, Jim, not you, not me, but there are some people who don't like Domino's pizza. Why? They're looking for something a little bit more thin.
Understandable.
And so this is a great product for those folks, and we're bringing incremental eaters into Domino's Pizza.
Now, younger people are telling me the offering $3 U-tip, we-tip promo matters again because people are pinching. Yes. They're pinching dollars.
Yeah. The R in Hungry for More is about renowned value. It's not just value. It's not just a price point. It's value that people talk about. And so all U-tip, we-tip it's a $3 bounce back. You buy pizza, you get $3 next time. That's boring. That's not renowned value. But everyone today is pretty frustrated. I was telling you a story earlier. Someone bought a chapstick the other day and was asked to tip for the chapstick. What? And so we kind of just changed the messaging and said, hey, let's call it U-tip, we-tip, but the mechanism the same. Everyone's talking about it.
Now, we had an outfit called 100X, and they were on, and they measure customer satisfaction. And you had the highest customer satisfaction in your segment. But they said, look, some of this is just because it's the price value.
Yeah.
It may not be the super best tasting, although, I happen to love it. But the fact is that you're offering something that seems to be reminiscent of before COVID, before things went crazy.
Yeah.
True?
Yeah. Well, the way we look at value is not just price. It's an equation, right? The price is the denominator. The benefits are the numerator. So what else can you give people? So one of the things I think is great about our price points is you can use our national promotions on any item. That's a benefit. Right. It's not just the pizza, it's sandwiches, it's pasta, it's salads, it's desserts. Most people now are getting a little bit of whiplash. Prices are higher. Now discounting is coming maybe on a certain item. Well, Jim, you may not want that item. At Domino's, you can get anything you want for our national promotion. And those are benefits. We feel like the more benefits, loyalty program's another one.
That we can are we put over on, 30 million? We're somewhere.
Well, I can confirm we're definitely over 30 million, but we'll give an update at the end of the year. We changed that program to get more frequency from our light users and our carrot users, and it's really working.
Well, look, my takeaway is the first thing you said, which is we're not used to getting anything other than positive surprises. Obviously, you're hungry to never have, again, a negative surprise, even though it was international and not necessarily under your control. And even though I don't think it was $10 per share, it was something that you're not proud of, and you're not going to let it happen again.
Nope.
Well, that's all that matters to me.
Yeah, and focus on that U.S. business. You'll see at the end of Q2, this was a really special quarter.
Excellent. Yeah. That's what I want to hear. Russell Wieters, the CEO of Domino's Pizza, DPZ, and you heard it right here. They have money's back in.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill.
Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the Light Round Convention. Rob Gold Stores. This team, the stock said buy, sell, different. Including stock, what's my space, play this out. And then the lightning round is over. Are you ready, Ski? Time for the Light Round Convention. Let's start with Gary in Ohio. Gary.
Hey, Jimmy Chill, how are you tonight?
I am doing well. How about you? What's going on?
I'm fine. I just want to shout out a big for all the Buckeyes in Ohio, and I do have a question on the stock here for you.
Sure, let's go. Let's go to work.
It has trouble getting traction. It's Salesforce.
It does have trouble getting traction. That's a nice way to put it. I've been kicking myself. I mean, should I have sold some higher for the trust? But you know what? We've owned it for a long time. It's been a huge winner. But I think it's a hold here. I would own the stock. Let's go to Tom in Ohio. Tom.
Hey, Jim, I got in this stock at $213 a share. I'm up over 500%. What are your thoughts on ADMA? Does it have more room to run?
Congratulations. I mean, that's been a rocket. And, you know, I have to tell you, if I were you, honestly, I would take some off the table because you've got it so that you can play with the house's money and never, ever worry. But I understand your strength. You obviously nailed it. And I do like this kind of biological company. But I want you to take a little off the table just so that I can sleep at night for your sake. Let's go to Anthony in Washington. Anthony.
Hey, Cramer. Thanks a lot. My stock is OUST. I've made a bunch of money on the way up. I want to see if I should double down and keep going from here. Or take
LiDAR, we've had this kind of moment here where it's come back into vogue. I would actually take some off the table. It's another part of this big small cap rally that we keep talking about. I think it's gotten ahead of itself. I would ring the register on something. Clarence in Connecticut. Clarence.
Happy Monday, Jimmy Chill.
You betcha, man. What's going on?
Well, let me tell you. I'm a few months older than you, but I've been following you since you took the Street.com public.
Oh, my God. 1999. It's unbelievable. What's happened?
All right, so here's my question. After hitting a high of 109 back the end of May, my stock has pulled back 25%. Still has a PE of 34. But I want to know, do I buy or wait for earnings or just avoid Vertex?
Oh, look, everyone's turned on the data center trade. I think it is the wrong thing down here to turn on it. I think we started to see good numbers from NVIDIA. Good pin action from NVIDIA. I would hold on to that stock. I would not sell that stock. Let's go to Leon in Pennsylvania, please. Leon.
Good evening, Jim. I'm interested in Suncor.
Look, I believe that everybody should have one oil. This one's got a nice yield of 4. I think you're in good shape with it. I would hold it. Let's go to Jim in Oklahoma. Jim.
Big Oklahoma booyah to you, Jim, and thanks for the investment club. What a great resource it is.
Yes, thank you very much.
I bought Kava when it came out, thanks to your good wisdom many months ago at 40, and it climbed to 98. I know it's in the discretionary consumer category. it dropped to 80 today. Is that just because of the category it's in? And
Yeah. I think that, look, this one, it has had a very, very big run. It's up 86%. A lot of the stocks that have had very big runs are coming in for sale. It's only a $9 billion company. It's going to have multiple years of goodness. I would just hold on to the stock, and if it dropped anymore, I would actually do some buy. Let's go to Austin in Oklahoma. Austin.
Hey, Jimmy, how's it going, sir? Huge fan of yours, man.
Oh, thank you. What's happening with you?
Oh, not much, man. The stock I'm calling about, it's been up about 28% in the last 3 months, and I'm not sure if it's too late to buy. It's a visual search and discovery company. Ticker is PINS, Pinterest.
Oh, boy, I tell you, I think Pinterest, you should be buying it hand over fist. I mean, I think this, by the way, is, along with Reddit, the new companies that you have to be in because of the advertising dollars. I like Pinterest very much. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Took a bad loss today for the investing club. We've done part of our position in the disaster that is Estee Lauder, the high-end, or some would just say plain expensive, cosmetics company that's faced endless guide downs and stupefying hours of judgment. Those negatives pale in the face of my own ill-advised strategy to stick with a loser, hoping it could somehow become a winner, even though Lauder's strategy is to bank on a potential turnaround in China, which just ain't happening. The Capital Trust's decision to back a seasoned pro like CEO Fabrizio Freda is all on me. I thought he could handle the China downturn, but he couldn't. I blame myself for believing when I should have been a skeptic. In truth, though, China has helped tarnish many a CEO, from Nike's John Donahoe to Starbucks' Luxman Varasimmon. Both CEOs are struggling, and their stocks, while not as horrendous as Estee Lauder, have been pretty abysmal, in part because of China. Nike's ad campaign, Am I a Bad Person, could be asked of Donahoe, or at least, Am I a Bad CEO? Because with every downturn, there has to be a fall guy, and right now that looks like Donahoe. You can't just blame Nike's downturn on China. The U.S. business ain't doing so hot either, calling into question whether Nike's run by a shoe dog or just a dog. How about Starbucks? The last of the iconic senior growth stocks that are mired in China. Shareholders got good news last week when we learned that Elliott Management, the incredibly rigorous activist firm, has taken a big stake in the company. Now, this one makes a ton of sense, though, and we have some for the Capital Trust, and we want more now that Elliott's in. Why? Because there's no doubt that Starbucks, the brand, is still great. It hasn't been destroyed by this regime. The company's just dogged down by mechanics like throughput, difficulty making new drinks, long lines. My hope is that Luxman sees how good Elliott is at orchestrating turnarounds and actually asks for their advice. Let him come to the table. If he chooses to go against Elliott, though, I think he and the company are in for the fight of their lives. Perhaps Starbucks will see its numbers benefit from what seems like a lull in the Gaza war. Remember, Starbucks was heavily protested by pro-Palestinian demonstrators around the globe, even though the company has zero connection with Israel. It doesn't even have any stores there, for heaven's sake. As for Estee Lauder, I'm not sure if their brands have been tarnished. Management's dismissal of the much cheaper e.l.f. brand was certainly an arrogant mistake. Their hope that China would come back misplaced. Nike, I know there's a belief on Wall Street that Nike sneakers have been eclipsed now by New Balance and challenged by Hoka and On. I actually share that belief. But Starbucks, I think, is all about the company failing to deliver. Elliott's in there because they know this business can be fixed, and when it's fixed, I believe the stock will go very quickly to $90, if not $100. If I want restricted in Starbucks for the Capital Trust, we'd be buying more right here, right now. Can't do it, though, because I just talked about it on air. My belief is that either Luxman and Varasimmon fixes it or Elliott finds a new team who will. The brand's so pristine, so good, that I have to believe that they can find the best leadership and have them right the ship, perhaps even before the end of the year. Starbucks is the only one of the three big China losers that I consider worth buying because it's the only one that doesn't have a demand problem. In fact, its problem is that it can't handle the demand. And that's a very high-quality problem indeed, which is why we upgraded today and told club members you're getting a chance to ride along with Elliott with or without the current Starbucks team. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.